It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host. Thanks for being with us. I'm also one of the certified financial planners on the show. With me in the KFG studio, certified financial planners, Josh Gregory and CPA Ryan Fair.
That's right. Well, friends, I hope you're enjoying this holiday season so far and are looking forward to the start of a new year. However, for those of us that are CPAs and financial planners, this is tax planning season, really. And today we get to have our friend and trusted tax advisor, Ryan Fair, here to help you make your list, check it twice, before the 2018 tax strategies expire and slip away. That and more today on our episode of Wise Money.
All right. If you have any questions, we're going to be hitting some tax questions second half of the show. If you have any questions, we'd love to hear from you. Call us or text us, 574-222-2000. That's 574-222-2000. You can find us online, wisemoneyradio.com. You can listen to previous episodes right there, but also submit a question right there on the right. It becomes an email, goes right to me. Also, all over our social media. You can find us on Facebook, YouTube, Twitter. The YouTube channel is up and running. If you want to see what Ryan looks like, you want to see us in the studio, go check it out. Just search Wise Money Radio that way. All right, welcome back, Ryan. He was just on the program about a month ago. We were talking about tax law changes, how important those are, and of course all the tax planning implications there. But today we're talking about one of my favorite topics, and that is just overall tax planning. And the IRS announced some changes that will impact potentially your tax planning for next year. So we're going to hit that as well. But let's dive right in. When it comes to tax planning, it's all about being proactive with your taxes. And I'm sort of a geek, so I like that rhymes a little bit. But some of those opportunities for you to get proactive, you've got to do something before the end of the year, before the clock strikes midnight on 12/31. Some other tax opportunities you have until your tax filing deadline, so April 15. I sort of want to break it into those two camps. Let's start with some tax planning strategies that you've got to get done before the end of the year.
Yeah. So yeah, there's a bunch of low-hanging fruit out there that we can start chipping away at with our checklist. Individuals, obviously, one of the big things we talk about this time of year is with the tax planning relates to education, 529 plans. So Indiana has an amazing 529 plan. I'm not going to go through all the details. We've talked about that a number of times, but you can only make those contributions through December 31st that qualify for 2018's Indiana credit.
And I would say it's got to be in the account. So you can't just say, well, I postmarked it or whatever. No, it's got to be in the account on the 31st.
That's a switch they made just a year or two ago, that it used to be if it was in the mail by the end of the year, you were fine, but they want to receive it. So, and actually they're requesting of professionals like us that we get it to them even a couple weeks before the end of the year, just because they know there's going to be a flood of dollars that come in. So do not procrastinate on that one. That one maybe needs to be on your list to get handled this weekend even.
Yep. And then I'm just going to plug one other thing. I know you didn't want to go too deep into this, but for those of you with college planning on the mind, next week we have a special guest, Dr. Greg Chenoweth, joining the program to talk about college planning and a few other things. So be sure to check that out as well. But yes, 529 plan contributions get you potentially in Indiana a 20% state tax credit, but you've got to get that funded before 12/31. It's got to be in the account.
Yep, absolutely. Some of the other stuff you can only do before year end all relates to capital gains. So right now, this time of year, we've seen lots of market volatility, and so we haven't seen losses in accounts for a while now, it seems like, and there's actually capital losses out there that people can go harvest. It's painful selling when you have a stock or a mutual fund that's down in your account, but look at it from a tax perspective. Go ahead and capture that loss. You can reinvest it in something else, not the exact same fund, but get on it.
So there's a flip side to that as well, because there are some folks who have owned some investments for a long, long time. And when you look back on 2017 and how amazing that year was in the investment world, a lot of people had their investments run up strongly during that time. Maybe they didn't sell or anything. They've held it right on in through 2018. And so there may be a little bit of a dip there. But the other thing you have to keep in mind, if you're owning mutual funds, they may be pushing out to you what are known as capital gain distributions. So you may have to pay tax on profits that you actually didn't generate by selling that mutual fund. Instead, you have to look kind of beneath the layer there, under the hood, so to speak, and realize that that mutual fund may have been selling some stuff at a profit.
Right.
And all those profits could get pushed through to you. So this is actually one of those years, potentially, where investors have experienced their own accounts falling in value, and yet they may end up having to pay some tax because their mutual funds are pushing these gains out to them.
Yep.
None of that is relevant if all your money is in an IRA or a Roth IRA, though. We're just talking about taxable accounts here. But don't be caught off guard or unprepared for that one.
I would also echo so tax loss harvesting. You probably haven't had to do that in 10 years,
Yeah,
maybe 8 years. But look at your account. Right, it is uncomfortable to look at it when the market's down this quarter and been all over the place, really. But the other thing is there also might be reason to capture a little bit of gain as well. And, if you're still in the 0, 10, or 12% tax bracket, then your federal capital gains rate's going to be 0. You would still have to pay state and local tax on that gain, but there might be some dollars that it would make sense to harvest. Because you're going to be paying 0% capital gains on that. So just take a planful approach there as well.
Yeah. One of the other things that Josh mentioned was, hey, with the way that the market's been the last few years, a lot of people did see a huge run up in stocks or funds in 2017 and even a little bit of 2018. But look at your charitable contribution strategy too. If you have individual stocks that have substantial gains on them, you can avoid some of those capital gains by gifting those shares to either a charitable organization or to a charitable trust type investment. There's lots of good planning that you can do with those stocks or funds that have really run up in recent years, and it needs to take into picture the whole charitable giving plan.
Yeah. Well, what you're getting at is that if you were to go sell that investment and write a check to that charitable organization, you have to first pay tax on the money, any of those gains, and then they receive the donation as a write-off to you potentially. But what if you could just skip the step of paying the tax on it yourself? You shift the entire asset to them and let them pay tax at their rate, which is zero, right?
Yeah, they're nonprofit.
So it's an amazing way to avoid tax on some of those great performing investments that you've held for a long time.
But you're still blessing this organization that that you want to support.
That's right.
But the other thing, you're right. Any charitable donation, you got to get in by 12/31.
Right.
And so many people used to itemize and they won't anymore. But if you're still going to itemize, I would consider, if you've got some clothes collecting dust and you're going to itemize, take those over to Goodwill. Get that done before 12/31 so you can have that part of your deduction.
Yep, absolutely. Also, from a business standpoint, there's a few things that you can start looking at before year end as well. Lots of small businesses, they've had a great year with the economy. That the way everything's booming. Even 1-person, 2-person small businesses. Look at a retirement plan. Some of those retirement plans have to be open before December 31st. You don't have to contribute to all of them before December 31st, but the account has to be open by December 31st, which is huge. You can get those contributions in and get the tax savings, but the account has to be opened or created before the end of the year.
Yeah, another example of that is the health savings account, right? You have to have that account open at your local bank or your credit union. If you're eligible to use an HSA, hopefully your employer has made a big deal about that to you. It's all dependent upon what type of health insurance plan they've offered to you. It has to be a high deductible plan and meet some other requirements. But if you have an HSA or health savings account available to you, maybe you haven't even decided whether or not you're going to contribute to it yet. But if you get the account open, you're buying yourself another 3 months. You have until April to get that contribution made.
Fantastic segue, Joshua Gregory. We are going to be talking about funding the HSA and funding a couple other things that you can actually fund up until April 15 and impact your 2018 taxes. There's still, though, a couple of things that need to be done before the end of 2018 if you want to get the most out of your tax planning. I'm thinking of at least one other for individuals and at least one other for businesses. Ryan's saying he's got a couple as well. So there's still a lot more tax planning opportunities we're going to hit coming up here on Wise Money with Korhorn Financial Group.
There's a whole bunch more.
A whole bunch. Oh, look at that list, Joshy. You're not gonna.
I'm taking over here.
No. All right, good stuff.
I can hear my breathing. So apparently I'm creeping in on the mic. I need you to just throw something at me.
Oh, I can do that.
I'm all stuffed up too, so I feel like I'm.
You know, I told you I had been feeling sick, but I was getting a little bit better. I feel worse today. So.
I think it's power of suggestion because you made me feel worse too.
Yes. You know, I have that effect on people.
When I talk to you, I just feel bad, Mike.
I just feel so much better about myself. I'm glad I'm not that guy. Okay.
All right, are we ready? We'll pick it back up with what items still have a 12/31 deadline. Do you have a full tax planning checklist that you are marking off to make sure that you capture all of your tax planning opportunities to make this year the least taxing as possible? I hope so. We're helping you with that today. This is Wise Money with Korhorn Financial Group. My name's Mike Bernard. Here with me in the KFG studios, CPA and CFP Ryan Fair. Between us, Joshua Gregory. Special thanks to the attorneys at Ledoux, Kern & Keene, as well as First State Bank for making the Wise Money Show possible. Thank you very much. If you have any questions, again, we're going to be hitting some tax questions coming up second half of the program. Reach out to us. Call or text 574-222-2000. That's 574-222-2000. WiseMoneyRadio.com is how you find us online. YouTube, Facebook, Twitter. Just search Wise Money Radio. Okay, so we've broken up the tax planning into two camps. Some things you've got to get done before 12/31 in order to help your 2018 taxes. Other things you have until April 15 potentially to help your 2018 taxes. We're still in the first camp. So Ryan, I think there's a couple other things that you've got to do before 12/31 in order to improve your 2018 taxes.
Yeah, I had a couple more listed, one for personal, one for business that I wanted to hit. For the business, year-end time is when you need to be reevaluating your depreciation strategy. So lots of time.
No one is thinking about that, Ryan.
Well, you should be. So the depreciation rules are very advantageous to write off a big chunk of your equipment, property, plant, and equipment expenses here before the end of the year. So if you are looking at, adding a certain piece of equipment sometime soon, it may make sense to do it before the end of the year so that you can write it off on this year's taxes as opposed to waiting till early 2019 to purchase it and then having to wait a full year to write it off and get that tax benefit. So reevaluate that stuff. Don't go out and spend money just to spend money, but do it with a tax mindset.
Absolutely. Yep. Absolutely.
Another, real quick, I'll hit on my other one that I had that I wanted to talk about related to individuals, and it has to do with required minimum distributions. Lots of people are required. Yes.
Josh has his checklist here. Josh always significantly over prepares for every show, and so he's got his checklist. And it was a very, very dramatic check that he just gave.
You're stealing my thunder here.
Yes,
but
that's
all right.
why I kept talking. I didn't want to stop because I needed to jump in. But so required minimum distribution. Once you turn age 70 and a half, you're required to take money out of your retirement accounts, your traditional IRAs, 401ks, 403bs, all of that stuff. Review all of those. Make sure that you get your distribution out before the end of the year. One piggyback on that is related to charitable giving. We talked about that in the first segment. There is an awesome plan that you're allowed to, it's called a qualified charitable distribution, or QCD. You can actually give a charitable contribution straight from your IRA to a designated charity, and you don't have to itemize to get that charitable deduction.
It allows you, it satisfies your RMD.
Yeah.
But it basically it doesn't become taxable and then you deduct it. It's just not taxable to you.
Right.
So it's awesome.
It's similar to the idea that we talked about in the last segment about what if rather than selling that stock
Right.
at a high profit and paying tax on it and then gifting cash to the charity, what if you just gave them the stock and let them cash it in? It's a similar effect because you don't have to count that IRA distribution as income to you.
But it's got to be for your RMD. You've got to be over age 7.5
Right.
in order to do that. You can't just do that if you're 59 or
Right.
61.
That's right. And RMD is a new term to a whole bunch of folks out there who turned 70 and a half this year. They know this lingo now. It's required minimum distribution. It's the required amount that you have to pull out of those retirement accounts each year so that you keep the IRS off your back here. If you miss this, it's a 50% penalty.
Did you guys hear that there's some push, some legal push to get rid of RMD? Have you guys heard that?
No.
Never happened.
No,
I don't
there's
think it'll
no
happen
way.
either. But there's actually I'm seeing some push about that. All
No,
right,
I
Josh, what else is on your list? I've got two more. Let's see who wins.
Okay, so one of the strategies that you've heard us talk about many times on this show, and now is the time of year where you would actually implement this, Roth conversions. This is where you shift money from an IRA to a Roth IRA, which is a taxable event to you, but it's not a penalized event as long as you pay those taxes that you're incurring out of your pocket or out of any potential refund. But the whole idea here is that if you know you're in a low tax bracket this year, because there's only a few weeks left in the year and there's not a lot of guesswork here, you may want to take advantage of that low tax bracket by paying tax on some of that IRA money, which has never been taxed before, getting it into a Roth IRA where any future growth happens tax-free. You'd never pay tax on that growth again. It's an amazing strategy. It's not something that we recommend that you really do early in the year. You wait until the end of the year when you have more clarity on what your tax picture is going to look like.
Especially this year, since you're not allowed to go back and undo that.
That's right.
Yep.
There's no do-overs on this
Right.
one. You got to get it right the first time. One other one, we've been talking about charitable contributions, and we recognize that needs to happen by the end of the year. But I'll just point out, for those of you that are supportive to a college or a university here in Indiana, maybe it's your alma mater, maybe it's just a school that you love to support or something. When you gift money to an Indiana college or university as a Hoosier yourself or an Indiana taxpayer, you can make yourself eligible for a state income tax credit. It's 50% of the contribution that you make up to the first $200 that you contribute. So in other words, if you give $200 to a local school, you're going to get $100 off on your Indiana tax return. So there's not that many tax incentives out there that give you 50 cents back when you donate $1, right? It's something that's it's a great incentive, I guess, to help support these schools that are doing great work.
I say, plus you still can itemize it as
If you're itemizing.
if you're itemizing
Yep.
it still, so it could be greater than 50%.
That's right.
Yep. Okay, I had one last one here, and it's really obscure, and we're late in the year. I get it, but I have some clients that I am really blessed to serve that have sort of created this support group where we've taken all of their paycheck and given it to their 401k. I'm just kidding. They haven't created a support group yet, but it is hard when you're working, and you get a zero check because it's all gone to your 401k. But some of you are looking at this year saying, wow, this was a great year. I made a lot of money, and with my income being so high, I might lose out on some deductions or some credits. And so how can I how can I still make as much as possible, but make my income look as low as possible? And I just met with someone this week where, she's getting a net zero check. You can't put money into your 401k once the year's over. It's got to come out of your paycheck. And so look at it, and some of you might be getting year-end bonuses. Look at that and say, should you put a significant portion of that into your 401k? Should you ramp that up for these last couple pay periods and contribute more? And then also with that, potentially withholdings as well. A lot of people, we've been warning you all year, a lot of people have had their withholdings go down more than what their tax benefit's going to be. Most people are receiving a tax benefit with the new tax laws, but your withholdings have gone down quite a bit. If you're going to be in trouble there, it might be the case where you want to bump up those withholdings pretty aggressively these last couple pay periods. So, anything else? All right, let's start dipping our big toe into the water. What are some of the tax planning strategies that you can implement after the beginning of the year, but before the April 15 deadline?
Yeah, so we've hit on a couple of them already, but just circling back, health savings account contributions, you can do those up until your filing deadline, and so you can, once your taxes are pretty well complete, you can mess with your contributions and see what the real impact to your return will be, and then get those contributions made before the end of the year.
I have to make a public service announcement about this because Ryan, you're going to know what I'm talking about because it happens a handful of times every single year. We meet with some folks in the spring. We realize they didn't fully max their HSA, and we tell them, hey, do you have an extra 1,000 or 2,000, whatever? Put that in your HSA for last year. It'll give you this deduction. And so they say, great. They go to the bank and they make that contribution, but they never tell the teller, or they do tell the teller, but they don't record it, that this was actually for last year.
Yep.
Make sure if you're making an HSA contribution, and same for IRA or Roth, which we're going to get to in a moment, for in 2019, but it's for tax year 2018, you've got to tell them that. Make sure it's crystal clear. Otherwise, it's a huge, huge mess. I teased out there's a couple others that you can, a couple other tax strategies that you can implement after 12/31, but before April 15, in order to help your taxes for 2018. We've got that and more coming up here on Wise Money with Korhorn Financial Group. So YouTube, we do lots of proactive planning, and we do some reactive planning where we get someone's tax return just about done, and we're reviewing it with them to make sure, again, those three questions, we answer all three of those that I tell you every time, that it's an accurate return. We know exactly where every number is coming from. And then, all right, what can we do to proactively, before we file this return, to make the return look as good as possible? And I don't know why. It's at least one every year where we say, oh, you could put an extra little bit in your HSA and evaluate that. Oh, that's a good idea. And then somehow there's some sort of misconnection, and that contribution is coded to the wrong tax year.
Well, and I've done that myself, where I'm contributing to an HSA during those first 3.5 months of the year, and I'm doing it online by just shifting money from one account to the HSA. And at least my bank, I don't know about yours, my credit union, it defaults that when you do it yourself online, it's going to put it in as a current year contribution. So I'm not actually affecting the tax year that I thought I was.
Same thing for IRAs and Roth IRAs. If you're doing those online, if you're not working with an advisor, I mean, of course, I'd encourage you to do so, and they can help service and all of that sort of stuff. But if you're doing that online yourself, there might not be an option for you to say, yep, I want this to go in for 2018, even though you're in 2019. With my bank, those electronic contributions for the HSA, they don't even give you an option. When you're making that transfer over, it just defaults to.
Yep.
Anyway. All right, so let's hit.
I'm down 4.08%.
Good.
Down.
Yeah. Buy.
Well, that's my 401k.
Yeah, you gotta keep
It's on sale.
keep
yeah.
investing.
That's right.
I know.
Okay.
It's not fun.
That makes you normal.
So that's normal.
Yeah,
Right now?
that is
Above
normal.
average? It's the international one that's
Yeah.
Oh, yeah.
really good.
Yep.
So
Russia's fault.
so
But
US
that's buying opportunity right there.
right.
Yeah, it's Russia's fault, exactly. Yeah, the Euro pack growth
Yep.
down 14%.
Yep.
But that is a fantastic mutual fund.
Long term. Yep.
So that flavor just happens to be out of favor right now.
Should I adjust my contributions? Keep it in there, but adjust my contributions to some of the other ones?
Nope.
If anything, you would do the opposite.
Right.
Buy more of that cheap stuff.
While it's down?
Mm-hmm.
But they're all down this year, so
Yeah, I've got
stay balanced.
mid cap is up, am cap is basically even, and then Wasatch is up. Everything else is down. So, all right, cool. Make sure I'm normal.
Yep.
Well, your investments are normal, Casey.
All right. Third segment. Did you know that some of your favorite tax sheltering strategies just got an increase in how much you can contribute to them for 2019. If you didn't hear that, we're going to break all that down for you, tell you exactly what you need to know so that starting 1/1 of 2019, you set the right contribution limits for all those. Take advantage of that. We've got that coming up. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard, coming to you from the KFG studios. Joshua Gregory, Ryan Fair with me as well. Want to say thank you to Bethel College Adult and Graduate Studies, as well as Diane Bennett with Remax 100 for partnering with the Wise Money Show. Thank you very much. So far, we've been discussing these tax planning opportunities, things you need to get done before 12/31, and things that you actually can do up until April 15. If you've missed anything, we've already hit the ones with the more urgent deadline. If you've missed anything, you can find every episode right there on the YouTube channel. Just search Wise Money Radio on YouTube, subscribe to it, like it, even share it to other folks that you know that could use some of the proactive tax guidance. You can call or text 574-222-2000. If you have a question for an upcoming show, a question for you personally, just reach out, call or text 574-222-2000. Lastly, find us online, Wise Money Radio as well. Submit questions, listen to previous episodes, all that sort of stuff. Okay, so there's a few other tax planning strategies that you can do retroactively, if you will, that after 12/31, but before April 15, you've got a window where you can actually look at a rough draft of your return or see maybe how things might land and then decide to do something about it. So we said HSA contributions, you could actually go back as long as you were eligible for an HSA and you had the account open. I teased out there you can do the same thing with IRAs and Roths, right?
Yep.
So what else it makes up that list, Ryan?
Yeah, really just the other retirement plans in that family. So SEP IRAs, you can go back and contribute to those and see what the impact is going to be, and also some of the profit sharing contributions.
Well, that SEP IRA, if you're not familiar with that one, you hear us talk about traditional IRAs all the time and this other animal, the Roth IRA, but SEP IRAs don't come up all that often. And it's really because they're created for business owners, small businesses, or self-employed individuals. Stands for Simplified Employee Pension, and then IRA added to it. It just has special rules, and it essentially allows you to contribute potentially much more money if you have a very profitable year. And it's hopefully something that's on your radar screen if you are a subcontractor somewhere or you're self-employed individual of some kind, a consultant or something like that. You may have big income, but the beauty of the SEP IRA is just the flexibility on how much you contribute and the timing of that contribution.
Yep.
You can wait until your tax return is done. You can push it out as far as your tax filing deadline with extensions. So you could be contributing in late summer, early fall to this account for the prior year. It's pretty awesome late stage tax planning tool.
That's right. Any others, Ryan, that I didn't have any either, although I did have one. Josh.
I have another one.
Okay, Josh. What do you
And Ryan mentioned this one as a tax planning tool to get in place before the end of the year. And that is if you're, again, a business owner and you purchase some equipment or tools, some sort of machinery, that kind of thing, a large asset, could even be a vehicle or furniture, you have to put that into service. It has to be delivered to you and in use before the end of the year. But you really have until the time you file your taxes to decide how you're going to write it off on your taxes.
And I would just, promote Ryan and our tax team because for the business owners that I get a chance to serve, and I know Josh and Kevin and Lance and Matt and Bill and Amy on the team, I mean, Ryan and Scott and our tax team, they do a great job with saying, all right, so this piece of equipment was purchased. I'm assuming we want to deduct all of it. Or, you know what, in their situation, it was a lower tax year, so let's take this sort of depreciation schedule. I don't know, but I would assume that's rare among tax preparers. And so I would give a big kudos to our tax team because, yeah, we're proactive about that. Yes, it has to be in use before 12/31, but you have until you file your taxes to decide and actually look at different ways of how that you should take that deduction.
There's a lot of business owners or farmers, self-employed individuals who just have a bias towards They've known for a number of years that they can buy a piece of equipment and write the whole thing off all in 1 year. And it's almost a knee-jerk reaction. It's automatic. I want that tax savings now because you love the money staying in your pocket come tax time. But having an intentional, proactive conversation with your tax advisor and your financial planner to think through out there in the future, those years that are coming, is your income rising? Is it going to stay flat? Is it declining? How does this year's tax bracket compare to future years is really what you're trying to decipher. Because the year that you take that write-off, that's when you're solidifying those tax savings, and we want to maximize them over time.
If you have a loss this year, and that mindset of I'm always going to deduct everything as soon as I can, I'm not sure that would make a ton of sense.
Right.
So you're right. Your CPA needs to be having discussions with your certified financial planner. You need to make those decisions in context of your entire situation, but also your anticipated tax and income situation for the couple years ahead. So great point. I'm glad you brought that one back up. Here's something else. On 1/1 of this year, if you're not maximizing your contributions to your retirement account, just go ahead. Just set yourself a reminder in your phone right now and say, hey, Siri, I'm just kidding. My watch and my phone's probably going to buzz. Increase my 401k contributions 1 or 2% starting at the beginning of the year. And it's not going to help you for last year, but we're kind of in between. We're going to tell you about the new contribution limits for all those fund accounts for 2019. But set that habit. If you increase it like clockwork, like that, over the next several years, the amount of tax savings, the amount of compound interest, the amount of growth, that is just a wonderful habit. So I'd encourage you to do that. Set yourself that reminder right now. 1/1/2019, increase your 401k, your 403b, whatever it is, increase that savings, your contribution amount by 1%.
There are some of you who are bold enough to do it now, though. If
Yeah.
you're not on pace to max it out here for 2018, you can make that increase now and just have yourself set on the right contribution path to max it out next year. And now, obviously, that's coming right before some of the holiday season here, and you might want
Just do
every take-home pay dollar that you can. But hopefully, you've already finished any gift shopping. That money's already spent. Go ahead and take action now while you're thinking of it.
Don't get mad at me, but of course I was done before Thanksgiving. I
my
told you
goodness.
that last year too.
Jeez.
I only have one person to shop for. It's my wife, and I just get her done. All right, let's talk about 2019 contribution limits. The IRS gets to tinker with these each year: 401k, IRA, Roth IRA, HSA, or they leave them the same. I think they left them the same in 2018. 2019. What are we looking at?
They're on the rise.
Hey!
So, yeah, the IRS released those rates a few weeks ago. And so yeah, we'll run through a few of them here. The one that impacts a lot of people with traditional IRA, Roth IRA contributions, historically, the last few years, couple years, we've been at $5,500 plus an extra catch-up. This year, the IRS has increased those contribution limits to $6,000 per person. And then if you happen to be over age 50, you get to do an extra $1,000, so up to $7,000 per person, which is heading in the right direction.
You remember when that was 2,000?
I was just getting into the business. I
Yeah.
was just starting my career when it was
Makes us
2000.
feel old, doesn't it?
Yeah, it's, absolutely. Man.
So
Okay.
$500 increase on that for
Yep.
those of you who are set up to max fund your Roth IRA or IRA through automatic payroll automatic contributions out of your checking account. You'll want to increase those amounts.
Yep. The other one, Mike was hitting on the 401k, 403b, retirement plan stuff through work. Those limits are up too this year. So we're up to $19,000 per person for 401ks, 403bs. And then the catch-up is still at $6,000. That's $25,000 into retirement plan if you're over age 50.
Can you imagine if you and your spouse were both working for an employer that had one of these types of accounts available to you? That's $50,000 that you could be saving in those late years when you're in your peak earning years.
Love it. A lot of you have simple IRAs. A lot of you have HSAs. We're going to hit those contributions as well. And then, as promised, listener questions. We've got a few of those to hit. That and more coming up here on Wise Money with Korhorn Financial Group. All right. show's going fast. It's 4 segment, right?
Yeah.
And YouTubers on our agenda here, which nothing's scripted, but we do have kind of a path we follow. We're still in the second. We're still in the second segment. Oh, that's funny. We're rounding out the show,
And we're at halfway.
and we're at the halfway point. I
Man,
would
I was
like.
saving all my good stuff for the end.
Were you?
Yeah.
I'm
I was
starting.
waiting. I was
I'm
wondering.
trying to track the pattern on which dates you refer to numerically and which ones you actually call them by their name, like 1/1/19, 12/31.
And
But
what have you found?
April, you actually call it by. I'm wondering why April's so special to you.
Carrington. Carrington was born in April.
Nice.
Yeah. 4/15. Yeah, I don't know. April. Yeah. That's weird. Thanks for bringing that up, Josh.
Lost for Josh.
It just stood out to me for some reason.
Plus,
It
Plus-
demonstrates how nerdy you are, though.
and yes,
When
and
you
and-
turn
He
everything
doesn't need
into a
any more
number.
help with that.
I know, and I probably shouldn't because there's just you longtime listeners of the Wise Money Show have probably counted the number of times I've messed up math and numbers on the show. I think we're up to 3 or maybe 4.
Yeah.
So
That's one of my favorite things about you, actually.
what? How frustrated I get when I do it, or just that it happens?
It just happens so innocently.
So I think maybe one of the last times it happened was I didn't jump in, but when you were talking about, you can get that the state tax credit for a donation. So I said something about, well, if you're also itemizing that $200 deduction will get you a $25. Or the $200 contribution will get you a $25 deduction if you're in the 25% tax bracket, plus the $100. And it's like, and I'm saying this, and I'm just going, and I'm looking at Josh and Kevin. They're like, what? No, what's wrong with you? Don't do math while you're also
There's padded walls.
talking on, yeah. So, hey, and I was going to bring this up. If you're married, you can both do 200.
That's right. Yeah. I intended to make that point,
yeah.
but
Well, so there's a little bonus content for YouTube though. But with taxes, there's always slight changes and then exceptions to changes and so on and so. I didn't want to announce that because I hadn't.
so
for sure
the
assumed
math
that was
is
still
then, if you and your spouse contributed a total of $400 to an Indiana college or university, you'll get up to $200 back on your Indiana return. And to Ryan's point, or yours, it's also potentially a tax write-off on your federal return if you're itemizing.
And if you're in the 22%
2%.
tax bracket, that $400. That's right. It'll be something. It'll help you out.
It'll give you a little something.
So, but no, it'd be close to $100.
Yeah.
And so you're taking $100 out of your pocket and giving $400 to that university. I mean, that's pretty cool.
Hey,
That's
YouTube is
amazing
also,
leverage.
Since you're getting bonus content here, look into, if you're charitably inclined, look into the Indiana School Scholarship Credit. If you feel like donating to private schools in Indiana, there's an amazing school scholarship credit. 50% credit on as much as you want to give.
Oh, really? I didn't know that there was no limit.
You have to have state tax liability to
Yeah.
offset, but
So it's basically the same structure as that college or university, except there's just not a $200 limit per
so
person.
there's some clients I know that give $10,000 a year. That's a $5,000 tax credit.
No way.
Yeah, it's huge.
Okay, so let's do a study on how many of our state legislators send their kids to private school.
Interesting. Don't be so cynical, Josh. Remind me
That's
of
not
Casey.
cynical, it's just curious.
Remind me of Casey Henriksen.
Oh, that's no good.
He did immediately hop on Google there, it looked like, to
Show content. All right. Fourth segment, land on the plane. We'll hit simple IRA, HSA limits, and if there are any others that are changing, and then maybe we'll just be able to hit Chad's question, maybe Braden's as well.
Okay.
Can you give a shameless plug for your team. Call hey, we're sending out tax organizers at the beginning of January. You don't absolutely need to have one, but if you want to get one from us, give us a call, send us an email, and we're taking tax appointments right now. So if you want to do face-to-face, if you want to drop off, just call the office, something like that.
Yeah, where do you want me to fit or do that?
I don't know. We'll
Interrupt Mike as he's bringing the show back.
yeah, say, hey, I just want to tell you. Yeah, just because that question might. So how about between
Segment 2 and 3?
yeah, between the content and jumping into Chad's question?
Okay.
I'll tee up. So. Do you have a plan set up to maximize and capture the increased contribution limits that the IRS just announced a few weeks ago? I hope so. We're telling you right now what those new limits are. This is Wise Money with Korhorn Financial Group. Thanks for being with us in the KFG studios. My name's Mike Bernard. Joshua Gregory with me, across from me, special guest CPA and CFP Ryan Fair. If you've missed anything, we've talked about all of the tax planning opportunities that you need to get done before 12/31. And then we've also made a list of all the tax planning opportunities that you have up until April 15 to do as well. So we basically have made your year-end tax planning checklist for you. Boy, if that seems like valuable content, go check us out on the podcast. Listen to the whole thing. Actually, before the show, Ryan was saying, a friend of his, just binge listen to a number of the podcast episodes. You can do that right in a row. You can subscribe to it. It's on Google Play. It's on iTunes, Apple iTunes as well, podcast. You'll want to search Wise Money with Korhorn Financial Group. That's Korhorn with a K. Every episode's also on the website, wisemoneyradio.com. It's also on the YouTube channel. Just search Wise Money Radio. All right, so the IRS announced new contribution limits for your favorite tax shelter accounts for 2019. The IRA and Roth IRA, so the traditional and Roth IRA contribution limits went from $5,500 to $6,000. That catch-up amount, if you're 50 or older, stays at $1,000. The 401k and 403b contribution limits increased from $18,500 to $19,000, and that catch-up is still $6,000. So you can do $25,000
Sure.
if you're 50 or older. You can do $25,000 into your 401k for 2019. What about simple IRAs, HSAs?
So lots of small employers have simple IRAs. They're great retirement plans for small business. The max contribution for those for 2019 is going to be $13,000 per person. And again, if you're over age 50, you can do an extra $3,000 catch up. So that's big. And then last one I want to hit is health savings accounts. So those vary every year as well. If you're a single person eligible for HSA, the max contribution is $3,500. And then this, for some reason, the age for the catch-up is different. So if you're over age 55 instead of 50, you can do an extra $1,000 for catch-up. And then for the family plan, if you have a family plan HSA, you can do $7,000 into that, plus an extra $1,000 catch-up. So
those limits are so confusing. I don't know
Yeah.
why. They twist those just a little bit. I know in the tax law proposals that were being pushed through Congress about a year ago, they were talking about increasing those limits significantly, and hopefully they pick those back up. I don't know.
And I think it's more important to just know what your particular options are going to be as opposed to knowing the exact dollar amounts, because they are changing. It's something that you can look up anytime. But you need to have these ideas in the back of your mind, because you never know when there's going to be surprise resources that show up in your hands. It could be a tax refund you weren't fully expecting. It could be inherited money, a big bonus that came in larger than expected. But when you have these surprise dollars and maybe you have a limited amount of time to take action and take advantage of some of these tax savings, you need to have at least a tentative game plan in mind already, and make sure that that game plan is consistent with your overall financial plan.
And then lastly, I would tell you, in the wake of those increased contribution limits, or even not, increase what you're contributing to your 4. If you're not maxing it out, increase it just a little bit, just a smidgen, 1%, 2%. I would tell you to do that 1-1. Josh even challenged you and said, just make that change right now. Yes, get in the habit of increasing those contribution limits just by a little bit each and every year. So, all right, we're going to transition into listener questions, but before we do, Ryan, you've got, our tax team is getting ready for tax season, and we'd love to help if you don't have a preparer right now or are looking for a new option. So
Yeah, absolutely. Now is the time. We're doing all of our tax planning as far as staffing and getting all of our supplies and materials and software and everything ready. Reach out to us. Right now, we're taking appointments for those, tax appointments. If you want to sit down and meet with somebody and have your taxes looked at, prepared for 2018, now's the time. Get in the books, get scheduled, give us a call. And if you don't want to meet with anybody and just want to get on our radar for dropping off taxes, again, now's the time. We will send out organizers at the first of the year where, we input your prior year tax return if you're a new client, and we will actually send you an organizer that helps, ask you some of these questions to get to know you better and understand your situation for the year, and then also help you just gather the materials that you need to be watching your mailbox for.
I can't stress enough the importance of putting in last year's return. If you're not an ongoing client, or let's say you bounce around to prepare, you're doing yourself a disservice.
Yeah.
There's a really big company that has a couple initials at the beginning of it that talk about how, we will double check last year's return. Oh my goodness. We actually double check last year's return.
Yeah.
And we catch a ton of mistakes made by that specific company. And so, my goodness, just gets me on a soapbox. So
yeah, but now is the time. I mean, if you come in February and March and April and need your taxes done at that point, we're still going to double check your return, but we're not going to take the time to input it for the prior year and do all of that work. But now is the time. We can help you out right now and get planned ahead.
Now is also the time to be running a proactive tax projection before the end of the year. If you can't look at your team of advisors and say confidently that your CPA and your financial advisor are collaborating to help you have a game plan for saving taxes over your whole lifetime, then now is the time to get that in place. There's still time in 2018.
That's right. Okay. Let's hit at least one listener question. Chad's 26 from Mishawaka. Here's what he asked. I'm wondering which is better, paying more on my student loans or increasing the amount I contribute to my 401k. I have about $40,000 left in student loans, and I'm currently contributing 6% to my 401k. I think I've got about an extra $500 a month or so I can devote to one of these. Which do you think is best?
You have an opinion?
I do.
What's your opinion, Ryan?
I was going to say, as long as he's taking advantage of the company match on the 401k, I would do that, and then I would crank the $500 towards that debt and get it paid off.
Mm-hmm.
Yeah.
So build the financial stability into your life. Get aggressive there. I agree. The first question is, are you getting the full match out of your employer's contributions? My mind actually went to the challenge that was given to me once when I was thinking maybe I had $500 that I could put towards something. Someone challenged me to do more. So reframe here. Chad, if you think you've got 500, rework the budget and make it 750. And have that be on top of the payments that you're already making, and just watch that 40,000 disappear. And the key, though, is I think it's important for you to first run a retirement projection and know with confidence what is the right amount for you to be saving so that someday when you've drawn your last paycheck, you have the right resources to be able to live off of as a supplement to Social Security or whatever other source of income you're going to have. The reason you need to know that number is I can about guarantee you that 6% is not that number. You're below where you need to be, but that doesn't mean you have to get there right now, today. I just want you to know how far below am I so that someday when those student loans are gone and you've freed up a whole bunch of cash flow, again, the current student payment or student loan payment and that $750 I'm challenging you with, when those can have a new home or a new purpose given to them, I want you to know how much of it needs to immediately be captured for that retirement goal that you're questioning about right now.
Mm-hmm. And even short of if at 26, you might say, I'm not running a retirement projection. So much is going to change. I would just tell you, you probably need to save 15%. You need to be saving 15% towards retirement. But I would agree with both Ryan and Josh. But I'd also point out Are there other areas in your financial life that probably have a higher priority? Are there emergency funds that you need to stash some dollars away in? And are there other things that you might be missing out on? And then lastly, I would say, with that 401k contribution at 26, just getting started, are you putting that into the right 401k? Is that going pre-tax or is that going Roth? So there again, you got to take a planning approach. Even at 26, when you say, really, I need a financial planner, I need to pay a financial planner. Yeah, you need at least to take a look and say, hey, am I pointed in the right direction? So I appreciate the question, Chad.
And that includes which investments are you choosing inside of that account as well.
That's right. That's right. Well, Chad, thanks for the question. We've got another question from Braden coming up, but we're going to have to delay that for a future discussion. Thanks for being with us. Ryan, always enjoy when you're on the program.
You bet. Thanks.
And so if you've missed anything on any of these tax planning strategies or creating that checklist, you can catch the previous episode, the whole episode right there on the YouTube channel. On behalf of Ryan, Fair, Josh Gregory, and myself, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.